right, good morning, everyone. My name is John Paul. Please let me know if you can hear me and if you could see my chart. Dwayne, Jeff, Larry, Mario, Mike, TL, Sven, Tom, everybody else. So we're going to cover something a little bit different today. Typically, my webinars are educational. I want you guys to learn something from when you attend these presentations. And these events are recorded. I'll post it on the blog on YouTube. And it's a good thing because that way you can review it and you can email me any questions that you have. Markets have been very slow lately, as you can see. So what we're going to do today is look at a review of 2017 and how you can actually look at the future and understand whether or not the market will pull back, what are the opportunities, what are the stops, what are the targets, all the things as traders that we try to understand and look at, but sometimes obviously a little bit harder under certain conditions. Now remember, before I begin the presentation, I want to make sure everyone is clear on the risks of trading. Trading is risky. Please don't trade with funds you cannot afford to lose. Everyone sees these disclaimers, but they are very important. Trading is risky, so please don't trade unnecessarily. Understand the risks and talk to your broker. Your broker can definitely guide you. He'll tell you what the margins are. And if you have any questions, we have all the disclaimers as well on the website with the risks of trading. So when you look here at the market as a day trader, 5-minute chart is very important. And it's very important because if you take a look at what most traders are looking at, here we have 60-minute, 30-minute, 15-minute, 10, 5. These are primarily what most traders are looking at in order to understand, should I go long, should I go short, and why. So the 5-minute chart is divisible by all of these, even the 3-minute and 1-minute to a certain degree. But typically you have swing traders and position traders looking at 60-minute or 30-minute, day traders at 15, 10, and 5. So the 5-minute chart really positions us in a good place. Now, in addition, the year so far has been an up year, and the market has been going and moving consecutively day after day higher and higher. So what I want to do is change our thinking a little bit and maybe have a forecast on how we can take advantage if the year is an up year. What we're going to do here is look at, and I'm going to teach you this throughout this webinar, what we're going to do here is look at a daily chart. Gives us a good guide on what the larger outlook of the market happens to be. Are we in a large uptrend or downtrend or flat? But there is a method that I teach every year for the past 10 years doing these webinars where the January month being higher close than open gives a good perspective on what the year will turn out. Will the year be flat? Will the year be lower? Will the year be higher? Now, it's not 100%, nothing is, and it's very close. I'd say it's probably 90% accurate throughout all the years that we have data on. If the month of January has a higher close than open, so really I'm looking at the first day in January, January 2nd or 3rd. So this year happens to be January 3rd. Here we are, 2017. And then we look at what happens at the end of January, so February 1st. Is this closing price higher than when it started? And the answer is yes. So this is a definitive fact. January close was higher than it opened. Any questions? Jeff, you okay with this? So now, how do I use this information to help me trade into the future? Well, if the market happens to continue higher and higher, there are opportunities. I can continue to buy it, and I can continue to look at breakouts to the upside. Now that's good, but I think there's a better way. And that better way happens to be with some type of retracement and then a follow-up when the market returns back to test the highs. So first of all, even though I know that the market made these highs here, there could be a double top, and there could be an area where it tests resistance and then doesn't break through it. So if you are going to play this method thinking the year is going to be higher, at least wait for it to prove itself. Wait for it to break above the highs of the year and go through it by a few points. I would say 2 points, 3 points, more than enough, and then you can go long. At least validate that it's not just a double top. Now, if you look down here, you could see this very important tool that I like to use on almost all of my trading, especially day trading. It's called the ATR. I'm using a setting of 4, regardless if it's a daily chart or a 5-minute chart or an hourly chart. And this tells me the current conditions. Now, I have hundreds of videos where I teach about the ATR, about scalping, about the Atlas line, about all the methods that I have. And I almost always have this ATR on there. So if you have any questions on how the ATR works, just do a quick search on the blog or on YouTube for under the Day Trade to Win YouTube page, and you'll see plenty of videos that I have outlining how this works. Essentially, I can expect 14 points at any time, up or down, from this day. Now I can expect 15 points. So you can see that it's relative to the current conditions. And if the market breaks the high of the year, wait. You can have a stop or stop with limit. That's fine. Yeah. So 2 points, you're long. And really the only profit target that I can expect would be 15 points. Now remember, always have stops. Protect yourself when trading. You can't trade without having some protective measure. So you should have a stop, and it definitely should be larger than what the current conditions are. Instead of getting stopped out unnecessarily or prematurely, know what your stop and your risk happens to be. So I can expect 15 points, and the market, I think, made more than that immediately in February. Now you can trail a stop. Again, I teach trailing stops, and I have plenty of videos on how trailing stops works. Just do a search on the blog, Day Trade to Win blog, or on the YouTube videos page. Now it makes a new high here. You're going to notice that the market begins to retrace and pull back and come back and come back and come back. It's not 1 day or 2 days or 3 days. I would definitely recommend at least 5, 6 days, something really significant as far as a retracement or a pullback after it makes new highs. From this point on, I want to go long, but I just can't jump in. So you're not just going to arbitrarily think, I hope it's going to go long here, I'm going long. Wait until the market begins to turn around and come back to test where the highs have been. And there's something that I try to reiterate always with my traders. Markets love to test where they've been. I say it all the time, and it's true. Markets are more comfortable trading where they have just previously been as opposed to going into uncharted territory. So I like to see the market retrace and pull back after it makes new highs, and then I like to see the market come back to test those highs. So what I'm going to do is I'm going to look here at this tool. It's the Fibonacci retracement tool. I'm not interested in any Fibonacci levels or any Fibonacci values. I'm only using this tool to help me understand the 50% value. My goal is to see the market stop and begin to retrace and come back. So you can see the market gave a great retracement, and now it's starting to come back. Where I want to go long is going to be 50%, breaking the 50% by a few points between this new high that was made, the retracement. As soon as it comes and breaks 2 points from the midpoint on its way to test the highs, that's the long. That's the long position. Now you can take the ATR, which happens to be about 20 points, 21 points. That's more than enough to make anyone happy. Ideally, you should see the market test those highs, at least trail a stop once it makes 1 times the ATR. And that way, you know that you're in the right zone. So now the market comes all the way back, going long, having a stop that should not be less than what this ATR happens to be, protecting yourself. The goal is to see it hit the highs, at least testing them. Now again, you see the market come back, good 4, 5, 6 days of solid retracement, not just a day or two. Let it definitely go against the overall move. This happens to be 60 points. It's a great retracement. The same thing is true. What you're going to see is from these highs, the market comes right back a few points from the midpoint. You're long only to test these highs. And again, I would recommend having 1 times the ATR about 23, 22 points as your target. And so from here to here, it's 27 points. And on and on and on. Again, another retracement. This one's not that pronounced. So if you're concerned and saying to yourself, I'm not sure if this is more of a channel or if a retracement, then don't consider it. Definitely don't look at this as a retracement if you're concerned that it's not a deep enough pullback. Here we are. I'm not suggesting that the market's going to pull back the next 5 or 6 days, but if it does, this is the recommendation. Let the market go against you or against the overall trend, let's say 5, 6 days. Once it starts to come back up to test the highs here, look at this opportunity to go long. Remember, since the January effect has a higher close and open, statistically, about 80, 90% even, out of all the years that January month has been an up month, the year has moved higher. But the opposite isn't true. If January is a down month, you can't expect the year to be lower or the year to be stagnant or choppy, or even if there's January as a down month, it could also mean the year can go up. But statistically, if January is higher close and open, the year is technically considered an up year. If you bought in January and you exited in December, you'd be ahead of the curve. But obviously, with all the ups and downs and the large stops, that's not possible for normal traders. So here, if this is the pullback or the retracement, when it begins to come back, a point or two, break, have a stop or stop with limit. Your goal is 1 times the ATR, and even better, testing the highs. Anyone have any questions on that? Very simple. You're being a swing trader, a position trader, but you're really calculating due to the fact that we have this January effect for the year, the market is always going to retrace and move higher, retrace and move higher, but do it correctly and use your stops and be careful when you trade, obviously. Now, the next thing I want to talk about, and this is so prepare for the market to come back maybe the month of August and September, October, November, huge rally into the end of the year. Now, the other thing I want to talk about are cycles. Cycles typically are not really discussed amongst traders. Maybe seasonality is discussed and spreads for different markets. But cycles, when it comes to the type of days that exist in back-to-back groupings, are really ignored in the larger part of the trading community. Because when you look at the grouping of days, you can probably assume that the grouping of days will continue and will be more of the same until the cycle changes. So I'm going to give you a good recommendation on how to use this to your advantage. The first thing is having this ATR tells me extremes. When the market is here on a day-to-day basis at about 24, 25 points, anything really above 20 to 25 points, this is a period of where we have higher than normal volatility and the days are larger, great trending days. So if you're wondering whether or not you should trend or trail a stop, thinking today's going to be a day where I'm just going to hold on to it and keep on going and going, you can't do that on every single day that comes around. If you have the proof that it's possible, look in and see that when the market is at these higher extremes, we have trends, we have opportunities to trail a stop. So as an example, when you have the ATR at these extremes, great for trailing stops, great for trends. When the market instead is slower than normal, you can see here's an extreme when the market's very slow, 10 points, 12 points. That's high to low on average. Last 4 days, you can't really do anything with this. These are choppy days. So if you're picking and choosing the days that work best, take a look at the overall cycle that we're in. You can't really trail a stop or take large profits or even expect the market to do anything under these conditions, as you can see here. And so let me show you, if I spread this out here a little bit, the example. This is just chop. These days here have on average a high to low of about 10 to 12 points, 13 points. It's very difficult to take a position and hold on to it. So either stay out, or I recommend taking very small targets because the market's not going to do anything or go anywhere, or just have this expectation of support, resistance, channel trading. It's just going to chop around, a lot of dojis, a lot of gaps. There's nobody here. On the flip side, if you take a look at when the market begins to break above 20 points, you have groupings and multiples of days, probably 3, 4, 5 or more, that are large range days. Great for trends, great for taking larger profits, and it's all relative. You can't expect the market always to be volatile or the market to be always very slow and choppy, but you do have to understand that the conditions change. And so the problem with most trading systems and the way that we configure moving average crossovers and MACDs and values, you got it, Mario. The the problem comes about with optimization. If you have one set of values that says, I've tested the last 10 days and this is the perfect number, moving forward into the future, if the conditions change, which they always do, those values will never work. So price action is really a focus of what I teach, taking out of the equation optimization. Moving averages, moving average crossovers, MACDs, channels, Keltner, Bollinger, stochastics, all those things sound great. You can optimize them to look perfect, but moving forward into the future, they'll never work. And so most of you here in the room, if you have any experience trading, you've probably realized over the evolution of a trader's education that you start off with indicators and then you learn that indicators may work for a certain time, but then when the conditions change, they don't work. But if you look at the current conditions, a simple ATR value of 4, like I like to use, immediately I know if I'm going to take a trailing stop or a larger target, or even if the market's tradable, these are the days that make much more sense to trade because here's where everybody is trading. And you have a grouping of days that are tradable. When the market begins to become slower and slower and slower, again, I realize the same effect is true. The cycle has changed. I won't be able to take large profits or trail a stop because here is a grouping of days where the market is slow. So you change your thinking and you adapt to the market. So there's no real optimization that's done. It's just an understanding of the current conditions that exist to guide you throughout the day or throughout the week or throughout the month. The same thing with here, like this. Now, I don't know on this candle, great 21 point ATR, that means from high to low, on average 20 points. I don't know that the next day is going to be choppy. I can only assume that we are in a cycle where the market is nice and healthy. So all this that you're seeing here with the ATR hovering around 20 points means I can expect a good run throughout the day. But When it begins to change and you see the market getting slower and slower, and that ATR is telling me that, and this is the equivalent, I quickly realize that we're heading into a cycle where this is not something I want to do. I don't want to trail a stop. I don't want to hold on to large profits. I want to maybe exit and not be involved with this environment, or take very small and very specific targets and trades. Does that make sense to everyone? Just adapt to the current conditions. We don't have to overcomplicate this. We don't have to make this harder than it has to be. It's just an understanding of the current conditions. It's just really price action. Now, as you can see where we are at the moment currently, the market was stagnant. So many of the traders that I work with ask me, the market's been so slow. What do we do? Well, hang tight, wait until the market begins to climb. And it's climbing. Do you see how the cycle is now beginning to change? Now, it could obviously get slow again, but once you have one day that really starts the run, moving forward, whether the market goes up or down, the range of the day, high to low, could be increasing day by day until it reaches 20 to 25 points. Again, an extreme, the cycle will then change, and then you'll see the market then get slow again, and you have the same understanding. Okay, the cycle has changed. I can't trade the same way. It's not the way it's supposed to be, and then it'll climb again. So as we get here into the end of summer, August is typically when I would say end of summer, beginning of back to school, everybody looks at coming back from vacation and starts seeing an increase in volatility throughout the end of the year into December. The options that you have are great days when the cycle here is hovering at between 20 and 25 points for trends, trailing stops, bigger moves. When the market starts to cross below, let's say 15, 14 points per day, the cycle is changing and that we have to be very careful with these choppy days and stops triggering, right? Because you can't expect those large range days. Does that make sense to everyone? Mario, any questions for me? Larry, Jersey, Frank, Dwayne, everybody else? When you think about a trend, you think about an up day or a down day. But believe it or not, the up day or down day is only half of what we consider a trend to be. When you take a look at, for example, we just have this very recently, this day right here. If you consider this a trend, a trending day, great. If you consider the next day a trending day, fantastic. It is a trending day. If you consider the next day a trending day, even better. But look at the days themselves. When you listen to the person on the TV, on the news, saying the market went up today, the market went down the next day, it's true. These are trending days. But the direction, either up or down, has nothing to do on whether or not the day was a trend. It's irrelevant. As traders, we can make money as the market goes up or as the market goes down. It's completely irrelevant. So when you see a day that is a large range day, that's a trend, I want you to put in your mind that tomorrow there's a high likely event that it will be another trending day, except the direction doesn't matter. You're not going to just assume because this day here was a down day that the next day will also be another down day. It could be, but I don't want you to be hung up on it and focus on it. Just think trend. The next day could be a trend again, but up or down. So direction has nothing to do with it. Again, the same thing as you see here. This is a trend up, large range day. This is a trend down. Look at the ATR above 20 points starting. So you start seeing the cycle, you start seeing trending days. Fantastic. Day traders can be in and out within the same day. If you know that the previous few days, this is where we're at with volatility, expect more trends, but direction, you can buy it or sell it. And the Atlas line works good. The scalper method, the trade scalper, works well on days like this. Now the market's beginning to slow down. Now you have a large range day right here. It's close to 20 points. What does that mean to me? It means the following day will most likely be another trending day, as if you see a grouping of days of the cycle. And a grouping of days, 4 or 5 days in a row, either a large range day up or a continuation to the downside. I have no idea how the day is going to play out. I just know I expect a large range day, possibly a good trend for me to trail a stop. The day went up instead. So a moving average crossover or any type of idea that says, okay, we have a large range day, go short, it's not entirely accurate. I much rather go short, if anything, testing where the lows have been or testing where the highs have been, entering at a better price. You're positioned much better than just following and going through the cycle. You'll be chopped up here. If you went short, you're getting chopped up. If you went long, you're getting chopped up. If you went short, you're getting killed. The same thing if I show you back-to-back days that are trends, they could be up days or down days. Here's another example here. Large range day, the next day a trend either up or down. This happens to be a trend started here. I'm not sure if it went down or up first, but it went up. So you can't always consider a red candle, a large trending down day will convert into the following day being more of the same. And let me show you a few more examples here. So here's an example of a trend and a large range day, and it really amounted to nothing. So my expectation was a large range day, the following day, like a grouping or cycle, didn't happen. The next few days, the ATR was still hovering around 20. So there's still great opportunities, lots of volatility, but it didn't follow through with back-to-back trending days. And just like this here. Any questions for me? We do have a new mentorship class, a group class, which includes all the courses and all the software, Trade Scalper, Atlas Line, At the Open 2, Roadmap, the Blueprint, X5, the price action scalping method, the Trade Scalper. So when I look at teaching the traders in the mentorship class, I really take it a step above just individual courses, and I teach everything that's involved with price action and all the methods. All right, everyone. Hopefully you enjoyed this webinar. You learned something. You're able to take advantage of the remainder of the year. Take a look at cycles, the ATR. If you're interested in joining our upcoming class, please feel free to call or email us at support@daytradetowin.com. Until next time, good trading.